Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video we're going to be doing a brief stock analysis on JP Morgan Chase stock, ticker symbol JPM. So most of you probably know JP Morgan is a bank, and we're going to look through the different sectors that they break their business down into here, because right now we're just looking at the earnings report from Q1 of 2021. So these right here are the results for the entire company, and then they break it down into each individual big business segment. So overall, we can see their net revenue for the quarter was $33 billion, which was up a little bit from $29 billion of the first quarter of last year. Obviously, last year that was going to be affected by the pandemic a little bit, but we can also see it's still above the fourth quarter of 2020 of $30 billion, so that's good to see. Their non-interest expenses were up a bit, around 18 billion, and then that leaves net income of around $14.3 billion, which is up a staggering amount of about $3 billion from the first quarter of last year. Obviously, that was impacted a lot by COVID, and so it's good to see there was a big rebound there, but it's also good to see that it's a little bit higher than the fourth quarter of 2020 as well. And then earnings per share from that net income were just $4.50 on a diluted basis, compared to 78 cents per share last year in the first quarter. And then they discuss some of the nuance behind those results. So they say net income, like we said, was $14.3 billion, which was up $11.4 billion from last year. And that was predominantly driven by credit reserve releases of $5.2 billion this year, compared to credit reserve builds of $6.8 billion in the prior year. And they note that net revenue of $33 billion is up 14%, and the non-interest revenue was $20 billion, which was up 39%. And that's primarily driven by higher consumer investment banking markets revenue and higher fees, and also some absence of losses in credit adjustments and markdowns on held for sale positions in the bridge book recorded in the prior year. They say net interest income was 13 billion, which is actually down 11%, predominantly driven by the impact of lower rates and partially offset by some balance sheet growth. They also note that their expenses, the non-interest related expenses at least, were up 18.7 billion, which is up 12%. And they said that was mostly driven by higher volume and revenue related expenses and investments. And then that increase also included a $550 million contribution to the firm's foundation. So I think that's like JP Morgan Foundation type thing that they're contributing to, which is cool to see. And then we're just going to quickly look through each of the segments a little bit. So the first segment is the consumer and community banking segment. So I guess that's mostly for individual people. They had net revenues of around $12.5 billion, which was actually down a little bit from last year of $13.3 billion. And then they break it down even further into consumer and business banking, which makes up a little under half of the revenue there, and then home lending, which is a small chunk, and then card and auto, which is also about half of the revenue there. And the cool thing to see here for the consumer segment is that of that $12.5 billion that they had in revenue, about $6.7 billion of it was net income. So that's over half of the revenue that is continuing on as income. And then looking at the corporate and investment banking segment, the net revenues for the first quarter around $14.6 billion, which was up from $10 billion in the prior year. And their expenses were up a fair bit as well. And then looking at the two different segments within the corporate investment banking segment, we had about $4.5 billion in banking revenue, which was up significantly from last year, and then about $10 billion in the markets and security services segment, which was up a fair bit of $7.4 billion last year. And that leaves net income of around $5.7 billion for this little segment. And then the commercial banking segment, revenues of around $2.4 billion. This is definitely one of the smaller segments. And they came out with a net income of $1.1 billion. And that revenue was a little bit higher than the first quarter last year. And the net income was significantly higher than last year, which they said was largely driven by reserve builds in the prior year. And then finally, the asset and wealth management segment, net revenues there of $4 billion, which is a little bit higher than the 3.4 from last year. Those probably aren't going to fluctuate all that much, since a lot of those people are still going to be investing and things like that in the long term, regardless of the pandemic. So that's good to see that those are, steady and increasing a little bit. And then net income was around $1.2 billion compared to about half that of $669 million last year. So the corporate segment, which is just kind of the overarching segment for the whole company, I believe, they actually had negative revenues, and I'm not exactly sure why that is. There's some different scenarios that can actually make that occur, but I'm sure they expand on that in the earnings call. I didn't listen to that at the moment. They don't really say why that happened here, but that would be interesting to learn. And then the net income total was actually negative 580 million, which was basically the amount that they donated to their foundation. So that's pretty much without that donation, they would have broken even there. So looking at the dividends real quickly, you can see their yield is right around 2.25% with a payout ratio of 27%, which is just fantastic there. They have plenty of room to grow that dividend, and recently they have been growing it pretty rapidly at a 5-year dividend growth rate of around 15%. The thing is, their dividend growth history is not that long, mainly because they cut the dividend in the financial crisis around 2008 to 2010 range. So that's why their dividend growth is not that hot. If you see, we're looking at the dividend history right now. If we go back, to maybe 2006 to 2008, you can see they were paying 38 cents per share, and then in the middle of 2009 here, they dropped down to 5 cents per share. Sorry about that. And then they started increasing it back in 2011 and have been doing that. Actually, they never actually increased the dividend in 2020. As you can see, they paid 90 cents each quarter. But since the total amount in 2020 was greater than in 2019, since they did increase in 2019, then that counts. And hopefully they will increase in the final quarter of 2021 to keep that streak alive. And hopefully it'll be a nice increase, maybe all the way up to $1 per share, which would be pretty cool. And looking real quick at the PE ratios, you can actually see that right now their PE ratio is 12, which a lot of people would think is super low, but generally for banks, I think that's just how it is. We'll look at that in a little bit at the moment. But you can see since 2010, it's been steady around 6, 7, 8, 9, 10, 11, 12, a little bit higher than that in 2018. So definitely, I would say it's not nearly as overvalued as a lot of other companies. At least compared to their historic PE ratios. They're definitely on the upper end of their historic range for the past 10 years or so, but compared to some other companies who are like way above their recent range of PE ratios, I think JP Morgan is probably at a pretty decent valuation. And comparing them to the banking sector, they're definitely in the banks or the financial sector. They're definitely in the banks industry. Within that, you can see the average PE for that industry is 12.5. So that's pretty much right in line where JP Morgan is at. The average for the financial industry or sector, sorry, the financial sector is 24. So they're definitely below that, but they have some high flyers in these other industries that are kind of bringing that up. So compared to other banks, I think JP Morgan is at a pretty decent valuation right now. But looking at their stock, they have been arguably on fire this year. You can see in the last year that's just been going pretty well. Sometime around the beginning of 2021, they announced those pretty massive buybacks they plan to do, and I think a lot of people got excited about that. And then also the buybacks started happening. So I think they did about $5 billion of share buybacks, maybe 4.5 in the first quarter alone. So that's pretty awesome, and we'll be looking forward to how much they do of that in the future. And just looking at my position in JP Morgan real quickly, you can see I have about 0.62 shares. And the current dividend yield, like I said, was 2.25%, but my yield on cost is actually just over 3% at 3.06%. And this position is 6.5% of my portfolio, almost crossing that $100 mark for that position. That would be super exciting when that gets there sometime soon. Either I buy more or the stock price goes up a little bit. And they pay me an annual dividend for my shares of $2.21. And hopefully we can get that up there by buying some more shares and by a nice dividend increase in the final quarter. I'm really looking forward to that one. And like I said, because of that difference between the dividend yield and yield on cost, my capital gains so far, at least unrealized, are pretty nice. You can see my average cost here is right around $117 compared to the share price of $160. So I have returns of around 36% on this position, which is pretty exciting. So let me know if you guys do own JP Morgan stock. I think it's one of the more popular bank stocks out there, at least for, more conservative blue chip investors. And I also do own another stock in the financial sector, and that one is Aflac, and I did a video on that. I'll leave a link right up here if you guys want to check that out. I think that would be a good one for you to watch. And I just want to thank you guys for watching to the end of the video. I really appreciate that, and I will see you in the next one.